For how long you've been here? I imagine that you've been in this field for over a decade.
Yes. So I've run my business for 10 years.
Yeah.
And then before that, I worked for another financial services business for 5 years. And then before that, I studied economics and finance at university and also studied throughout my time working at university as well. So 15 years.
So you went through pretty different markets, right? You went through volatile markets, expansion. Now we're looking at US and we're looking AI.
So I'd say it was actually pretty smooth sailing. So I started just after the GFC.
Yeah.
And so that was an environment of lower interest rates, generally markets expanding, fairly low volatility. The last few years have been very volatile. So COVID was obviously very volatile. Interest rate settings have moved around a lot. And now we're seeing the investment capex cycle around artificial intelligence take off. And that's also distorting some of the data. So the last few years have been a much more interesting period to invest than perhaps the preceding decade.
So talking about AI and the last report that came from Bunnings CEO about productivity, they meant to increase the revenue based on productivity, not based on sales. So if I understand correctly, his view is that AI actually pays off.
So I think generally people don't understand what productivity actually means. So productivity is not directly measurable. So we observe it as an outcome of two other things we measure.
Yeah.
We measure the input costs and we measure the incoming revenue. And if input costs grow 2%, but revenue grows 4%, then there's a 2% delta between the 4% growth of revenue and 2% cost growth that we attribute to productivity.
Yeah.
So that's kind of how we observe productivity, but we're never actually directly measuring it. And so what we've seen in the United States broadly, so taking the Bunnings example and extrapolating expansion in profit margins. And that profit margin expansion has been a structural theme that's been going on for 10 years.
Okay.
It's not specifically to do with AI, perhaps, could be, but profit margins have been expanding for a longer period of time than just this recent AI to capex boom.
So you've suggested that recession risk in the US remains meaningful, right? If a founder is building or planning an exit in the next 2 to 3 years.
Yeah. So I guess the way to start thinking about that is to frame it. What is the typical risk of recession? And in any one given year is about 15%.
Yeah.
Right. So if I say I think it's elevated, I'm probably just saying relative to a 15% chance this year, it's elevated. And maybe that's 30% chance. And so the risk of recession is still not a base case. It's still generally an expansion is what I would expect. But obviously, if there is a heightened risk of a slowdown, I think you would need to be careful about how committed you get in terms of your long-term capital expenditure plans as a business owner in case your demand for your product or service goes through a bit of a volatile swing. But my view on that recession risk has come down. The labor market appears to be in a little bit of a recovery in the US. So some of those risks that I thought were more heightened maybe a year ago seem to be fading a little bit. But generally speaking, the risk is still higher than normal.
How does it directly affect Australian market though?
So the saying is, if America sneezes, the world catches a cold.
Okay.
Have you heard that saying? Yeah. So the US market is the largest market for final consumption.
Yeah.
It has an extraordinarily large trade deficit. So it consumes a lot more from the global economy than it sells to the global economy. It has a very large trade deficit. And what that means is if the US consumer and the US economy slows down, then so does their consumption of global trade surpluses. And one of the biggest global trade surpluses, well, the biggest, is China. And of course, if the Chinese economy struggles because they can't sell to US consumers, even though they might be doing that through intermediate countries, then the Australian economy will struggle because China is our largest export market. So to the extent that there's a pretty clean link between how the US economy fares to how the Australian economy fares, it really goes through China in terms of China's relative strength or weakness and their ability to sell their things to the US. The US matters.
What would you say are the differences between, as it is today, if I'm a startup who is looking into two markets, US and Australia, what is the benefits of investing or starting a startup or scaling a startup in Australia in comparison to US?
Yeah, so pros and cons. So the American economy is typically seen as more productive. So it's seen as a reasonably good place to do business. It tends to have lower bureaucracy. It tends to have pretty good bankruptcy like proceedings. So businesses fail there all the time. Whereas Australia, it tends to have a slightly higher cost base to operate a business because we have higher labor standards. We're not seen as productive. And so when you look at the business settings, I think America might be an easier place to do business, particularly if you go into a certain state where they have lower tax settings. But on the flip side, you've got Australia is a very wealthy country. So we, I think, have the fourth largest pool of investment savings in the world, even though we're in the 14th largest economy. So we're a very wealthy country. We've got a lot of investment capital that needs to be allocated. And the structure of that capital in Australia is very different to the capital in the US. Yes, people talk about the US having a big private equity ecosystem, but Australia has a very disaggregated superannuation system. And so there are lots of individual Australian investors running their own superannuation structure as opposed to Americans who sit inside a very large externally managed 401k, or maybe they're in the New York retirement plan. And those American superannuation or their pensions settings, they're very large pools of capital. They can't go and just make a $300,000 investment in a startup business because it's, even if that business grows 10 times, it won't have any attribution to the overall performance of that pension scheme because it's $1 billion pension scheme. So it just doesn't make sense for capital to be allocated by these large pension plans into these very small startup businesses. So if you're a startup founder looking for capital, particularly if you're a smaller business, Australia is actually a really good place to come do that because we have a lot of people who are able to write $100,000, $200,000, $300,000 checks, where if the returns are good, it has a meaningful attribution on their outcomes because it's not sort of aggregated with all the other investors because we do have a much more fragmented superannuation system. So there are pros and cons.
If someone relocates to Australia before an exit, what financial considerations should they be aware of?
Yeah, so I guess the obvious one is just thinking about tax. So the obvious one is all of a sudden you become an Australian tax resident, you live in Australia for 6 months and 1 day in that 12-month period. You have to lodge an Australian-based tax return. Therefore, you're going to be attributable to whatever the Australian tax settings are on your exit. So you might have run a business out of somewhere in Europe, for instance, and you hold your shares in a company or units in a unit trust, whatever the structure is in that business. You come to Australia, you reside here as a resident. That's now considered a foreign investment. And so when you sell it, you make a capital gain on that, whatever capital gain is becomes part of your assessable income in Australia.
Yes, that's where wealth management comes into the place, right? You could most probably start structuring early your superannuation and your tax allocations.
So the best time to structure your wealth when you're setting up a business or founding a company is actually in the foundation set stage. So before you even open the bank account, do you have a family trust in place, or do you have a company in place, or do you have a company where the shares in the company are owned by your family trust? Because if you set up the business, say, just as a company and you and your co-founder just own 50% shares in that company, then any potential exit is going to be a capital gain that is attributable to those two individuals. Whereas if the shareholding were owned by the family trust, then the capital gain from the company share exit, so that you attribute to a successful exit, gets to flow through the trust and be distributed to a variety of different beneficiaries, which can lower the tax impact for the founder. So the challenge is if you come to Australia and you're an individual shareholding owner of a company that you founded and you want to move it from being in your name into a family trust, that's considered a change of ownership. And that change of ownership would trigger a capital gains tax event. So you can't retrospectively adjust the shareholding settings in a company that you might be operating through without triggering tax events. So you've got to get the structuring right up front. So the next opportunity to get the structuring right would be if you sell a part of your company to angel investor or private equity firm, you can explore ways of rolling into their structure and then using that as a change of ownership event to prevent future capital gains impacts. And then the last one, obviously from a wealth management perspective, is when you fully exit, you'll have a lump of capital, you'll have a big tax bill to pay. So don't just allocate the nominal exit, just think about what the net impact is after you pay your tax before you start making capital allocation decisions.
Is there any threshold when it's more considering the family trust rather than just doing normal proprietary limited and normal accounting? So if my revenue is still under 1 million and I don't know if it will grow, it will not grow, should I consider still doing family trust? What is the cost associated with running family trust? Because it's a lot of accounting, right?
Well, if you're already running a company, you're lodging a tax return for the company.
Yeah.
You can't avoid that. Every year you're preparing financials for that. Having the shareholder of the shares in the company be a family trust, it introduces another entity that you have to lodge returns for and a set of financials for. But even if it were a non-working partner and you're generating a profit from your business, including your income of, say, 200,000, so a lower figure than you were mentioning, if it meant that you paid yourself 150,000 and then you pushed 50,000 to your non-working partner, you would lower your tax there by, I don't know, ballpark figure, 15 grand.
Okay.
Yeah, just doing that one tweak in terms of the ownership structure. And so that $15,000 should more than cover the administration costs of paying the accountant to run those two entities. So actually the threshold for the use of the family trusts in a productive setting, quite low, dependent on your partner's circumstances or the relative beneficiary circumstances, noting you can't distribute income to minors. So you might have kids. If they're under 18, you can't use them as beneficiaries, but maybe they're over 18 at university.
You can use them as beneficiaries.
You can start using them as well. Everyone's got a $20,000 tax-free threshold. So all of a sudden you can actually strip out quite a bit of tax costs. Now, you get advice from an accountant for that, but I think it should be relatively straightforward to get a return on investment.
Are valuations today being supported by optimism rather than fundamental?
Yeah, so I guess I can draw back to the point I made about profit margins expanding. And so maybe part of the picture is that businesses are productive and they are generating more profits. And so there's some validation that the quality of business has improved. And so we deserve a better valuation relative to past. But that's the fundamental attribution piece. But nonetheless, like however you cut it, if you look at the forward price to earnings multiple, which is what's the share value divided by the earnings per that share, historically that trades at, say, 17, 18 times. For instance, right now it's trading at 22, 23 times.
Okay.
That's a lot. That's a very high multiple. And that's just on a forward PE sort of basis. Or you can look at Cape Shiller, which is a cyclically adjusted price earnings ratio. That's a longer term one that adjusts out the cyclical changes in earnings. So you're not getting the big cycle impacts. That's really stretched. So based on valuations, the share markets look very expensive. And so the prospective return for the next period of time, it either needs to see a lot of earnings growth to catch up to those valuations, or we need to see valuations come down. So how do we normalize the current valuation settings? And there's two pathways to get there, and I don't know which pathway will follow.
I guess in US, this is what it is. It always is just you get into the market, you scale fast, you sell and you move on, right?
Yeah.
I think in Australia, it's more of the more conservative approach to startups. You get into the market, you start testing the market, you get your customers. That scale is not very visible here. Do you see?
I think it's hard to stereotype like the right approach because businesses are very different and what works for a different business, I think will be individually determined. But certainly there was a period, particularly when interest rates were much lower, where investors were very happy to reward businesses for a rapid rate of growth, even if they didn't have maybe the cash flow to reflect that growth. So maybe, they were scaling really fast, but it was an expensive route to market and they won't be able to show a near-term profit. But investors were so willing to look through that sort of near-term financial pain because the growth was so fast that eventually they were going to make money. So that patience was going to be rewarded, I think, a couple of years ago. I think the challenge for the business now in terms of meeting the market of investor expectations is that investors are cautious that, hey, we've got this AI revolution coming, this productivity revolution that may or may not arrive. But if it arrives at sometime in the next 3 years, then what does your business look like in 5 years? And the way I think about it, it's almost like an event horizon of a black hole. I don't know what the world's going to look like in 5 years as an investor.
The world is changing in 6 months, right? Pretty much.
But particularly the sort of startup businesses that might be reliant on developing technology or a quick route to market. They've got a great idea. How able are you to prevent disruption from AI? And a new product fit that's slightly better than yours, and that can be built with one uni student and a laptop. It can disrupt a business of 50 employees, for instance. And so I don't know if investors are patient right now in terms of saying, well, I don't mind if you don't show me a return in the next 3 years, so long as the growth is there and I'll price the earnings in 5 years' time very generously. I just don't think investors are now being generous around future earnings because they're concerned that the disruption from AI development and innovation is so significant that they just don't know what a business will look like in 5 years. So I think what used to be the case, fast route to market growth, I think may still work, but you've got to show that earnings growth is somewhat protected from AI disruption if you're going to pursue that pathway.
How should founders think about concentration risk if most of the wealth is in company equity?
That's a good question. So I think this is somewhere where I have maybe a slightly different view to the typical investment advisor.
Interesting.
Where there's this, you go speak to a financial advisor and they're obsessed with this word diversification.
Yes.
They're obsessed with it.
Yeah.
And you learn all about this at university. This is the thing that you're always taught, diversify, diversify, diversify. And to the extent that there's even barbecue sayings, diversification is the only free lunch sort of thing. These things are around all the time.
Yeah.
And if you look at the world's wealthiest people, think about Bill Gates, Jeff Bezos, the French founder of the luxury brand Louis Vuitton, almost invariably the wealthiest people in the world have made their wealth in a single business.
Mm-hmm.
And so they've been very, very concentrated. And you think, well, okay, that's not relevant to me, or maybe it is if you're a founder thinking about growing a business, but maybe you're thinking about an investor, like, should you be concentrated or not? The reality is, if you had a really good business that you thought was going to grow really well, and every other business you thought was going to grow a little bit less well, mathematically, it doesn't make sense to diversify into the things that are going to do less well away from the one business really well that's going to do well.
Yeah.
And so I think as a founder, when your wealth is tied up in one business, that's only a problem when you as a founder think that business fortunes aren't going to do well.
Okay.
So there's a great Mark Twain quote, which is often quoted by Stanley Druckenmiller, who's a very good investor. He runs his own family office. Investors definitely know who he is. He's a very successful trader. And he says, put all your eggs in one basket and watch that basket closely. And so I think for a founder, because you're in a position where maybe all your wealth's tied up in a business, but are you watching that wealth very closely and you have your hands on the rudder, you can steer the business in the direction that's profitable. So long as you're a good founder and you're making good capital management decisions in your business, hopefully that should be more productive than just a benchmark equity allocation. And so I don't think there's any problem with allocations concentrated for a founder, so long as the founder is running a good business.
And is realistic about it, because there are many founders that has distorted reality about their own idea and baby, and that's where you want someone else, a third person or an investor or some financial advisor to look into that.
There is no place for sentimentality.
Exactly.
Being an emotional founder is great for connecting with customers and building good culture inside a business. That's important. And how you connect with people, very important for growing a business. But being emotional about how you think about the business, the capital allocation decisions, which components of the business are generating revenue that covers the costs and cost management decisions, is not very helpful. You need to be a little bit, not ruthless, but you certainly have to be
realistic,
honest with yourself.
Compared to the US, how would you describe Australia from a wealth stability perspective?
So this is a super interesting question, because on a median wealth per capita basis, Australia is the second wealthiest country in the world. I think we're after Luxembourg. That's median, so different to average.
Okay.
And that just speaks to the fact that maybe Australian houses are too expensive, and so every Australian looks wealthy on paper. Perhaps that's part of it. It also, I think, speaks to the success of our superannuation scheme, which has forced contributions into retirement savings across everyone, and those retirement savings have done fairly well. So we're almost more egalitarian than most countries as well. Maybe that's changing, but certainly the data would suggest Australia's, from an individual wealth standpoint, individual Australians are doing very well on a global stage. So compared to the US, we're better off on the average person on the street. In Australia, much better off than the average American on the street. So that's from an individual standpoint. And then if you tackle the question, where's Australia relative to the US on a wealth standpoint from a macro perspective, I think there are interesting backdrop to this question is that the US has a very large current account deficit, which is that it buys a lot from the world more than it sells the world. So its trade balance is very poor. And it has a very large fiscal deficit. And so its government is spending a hell of a lot more than it's taxing. And so they call that the twin deficit. And the twin deficit as a percentage of GDP in the US is something like 9%. That's not sustainable. Whereas in Australia, it's maybe more like 2.5%, 3% perhaps. So we have this issue in the US where they need to shift the settings of their economy in a big way in the medium term, because what they're doing now is just not sustainable. And the adjustment to that new regime, whatever that looks like, has to happen in a number of different ways, but it probably is going to require more taxes in the US, reduced spending, which will create fiscal drag, so probably a tougher outlook on the US economy at some point, and it will require probably a lower US dollar as well. So there are bumps in the road ahead for the US just because of the unsustainability of their current macro settings. Australia having a much better backdrop. The other factor, again, is then political. Part of the backdrop in the US with its unsustainable twin deficits is it's created a lot of inequality, because the other side of the current account deficit is the capital account surplus, in that the US is selling more than it's buying. Then there are more US dollars going out into the marketplace to the rest of the global economy. That's been happening for a long time. And so what do the recipients of that those US dollars do? Well, typically they just take those US dollars and buy US assets, and that's the capital account. And so there's this offsetting capital account surplus, and that's bidding up US assets. And of course, if you're American and you've got assets, that's great. You become wealthier and wealthier. But if you're not a wealthy person, you're not benefiting from that capital account surplus. And so you've seen inequality sort of drift further and further apart in the US. The challenge that they have is that the inequality has created a very polarizing backdrop in the US. And so I think you're going to get these very sort of knee-jerk political environments as you rotate from one extreme to the other.
Yeah.
And so you've got the twin deficits, that's going to be a bumpy road, and you've got political polarization, that's going to be a bumpy road in the US, whereas in Australia, we don't have that twin deficit problem to the same extent.
Is money still flowing into tech or becoming more selective?
I think the best barometer for this is, for the last maybe 7 years, investors and the general public, I think, have talked about the Magnificent Seven.
Yeah.
Those top 7 stocks in the US, and I'm not going to name them all, but it's your Microsofts and Googles, it's Meta. And so they've all sort of had quite a strong correlation historically. And so they've been reflective of market sentiment. They've been reflective of the capital account forces that I mentioned earlier. And that movement of the Magnificent Seven up and down since October last year, there's been a fragmentation. So what we are seeing in terms of technology expectations from investors is now much more nuanced. No longer seeing this perfectly correlated sort of sentiment gauge around technology stocks. We're seeing a little bit of punishment for some and a little bit of rewarding for others. So there's a bit, I would say, more price discovery. The best example of that is the SaaS apocalypse. So these software companies where Anthropic came out with a new software generation tool, and people realize, hey, my software is not as strong as I thought it was. The moat being the protection to competition in your business, and investors have significantly punished those companies. Now, the thing is, if AI is not as productive as we think it is, if it doesn't end up creating a productivity paradigm shift, and it disappoints, and so investors then punish a lot of AI investors, hyperscalers who are doing the data center build-outs and all the private credit lenders into data centers and things like that. If we end up getting a disappointment story, you might actually find that a great way to trade that is to actually buy these software companies that are sold off a lot, because they're not going to get disrupted. But certainly there has been a pricing out of a lot of long-term future earnings due to the uncertainty of AI disruption. So capital has been very selective now.
Interesting. If a startup comes to Australia, is there anything you can help them with?
Big challenges I see when people come to Australia, and one of the weirdest things about Australia that I think it's hard to fully understand until you're here, is just the overwhelming impact of housing. Housing in places like Sydney and Melbourne is very expensive relative to income. I think Sydney has the second highest value houses anywhere in the world relative to median income after Hong Kong. Hong Kong's prices are falling, Sydney's are still going up. So the challenge for anyone moving to Sydney is that if it's a long-term home for them, a lot of their wealth resources, should they want to own where they want to live long term end up getting tied into housing. So there isn't always a lot of flexibility around external wealth beyond that. Now, obviously, if you're coming to Australia with a successful business and you've got a few $1 million spare, of course, you go and buy a house, maybe take a small mortgage, and still then have the ability to think about investing.
If someone is looking for advice, can they contact you?
Yeah, for sure. So my approach to financial advice generally is starting with a strategic concept. So the first meeting is a workshop. It goes for about 90 minutes. It's about figuring out what is the strategic direction that you're actually on. So not even talking about investing or insurances or mortgages, anything like that, but just big picture, like what's your life plan? What are the financial implications of your life plan? What are the pros and cons of the current decisions you're thinking about making? What are other decisions that you might consider that could optimize what you're thinking? And only then, once you've got a sense of strategic direction, is it then worth talking about more tactical things like, okay, this is how you would structure the mortgage. This is how you do the debt recycling. These are the insurances you should be thinking about. Hey, you've got $3 million of wealth here. This is how you should think about structuring the entities to run sort of the investments. And here's what the investments look like.